Well, good afternoon and welcome to this first edition. Of course, it's not the first edition of Finweek. It's we've many Finweeks down the road, but of course, welcome to Finweek Money Matters, the show that helps you manage your finances. I'm Samantha Loring, and Garth Tennyson, Finweek editor, is joining us today. And Garth, you're not the Finweek editor, so I don't know what's going on with the script today. It seems there's a bit of confusion here, but Garth Tennyson is my guest host today. On the show today, we're taking a look at the man that built famous brands, Kevin Hedderwick, and we'll take a look at the personal finance section, at some financial tools that have come out, some interesting ones. We'll take a look at innovations there. And then in the entrepreneurship section, we're taking a look at the talent drain in the finance industry. That's all coming up in the next hour, so do stay tuned for that. Of course, if you have any comments or suggestions, you can send them through to moneymatters@abn360.com. And of course, you can also find us, Garth and myself, on Twitter if you have any comments for us throughout the show. Well, in the Finweek cover section this week, we look at the man who rose through the ranks in an unorthodox way and went on to build South Africa's mega restaurant chain retailer, which boasts brands like Debonairs, Wimpy, Tasha's and Mug and Bean, to name but a few. He hails from East London in the Eastern Cape and says in his school, one had to fight for their lunch. Many believe this quality and spirit has never left him. He is Kevin Hedderwick, and he is the CEO of Famous Brands. Joining us for this discussion, Finweek deputy editor and journalist Sizwe Mahluchana, Garth Tennyson, and Keith McLachlan, small caps analyst from Tebe Securities. Anthony Clark also joining us from Cape Town, and he of course is a small caps analyst at Vunani Securities. Garth, you wrote the cover story. Kevin managed to make it onto the front cover of Finweek this week. Why do you think he deserves to be there?
Well, in many ways, he's quite an entrepreneurial guy, and one of the things we're trying to do at Finweek is focus more on the people behind businesses. One of the reasons he intrigued me personally is I quite like meeting CEOs who aren't CAs. It seems like, to me at least in South Africa, if you're not a CA, you'll never be a CEO. I know that there are exceptions to that rule, if I can call it that. But here's the guy who kind of worked his way up the old-fashioned way. Started out as a sales rep, working for Distel in Port Elizabeth, and just slowly worked his way up the corporate ladder. Mm-hmm. Eventually broke away from SAB when he was working there to help start the Keg. And when his
he talked about that SAB training really as the most corporate and kind of academic training he received in his career.
Well, he describes SAB as probably South Africa's finest business school, and he was very complimentary of them and said he learned a hell of a lot from them. And if he were to have an MBA, it would be his time at SAB. So definitely someone who's learned about corporate life, as I say, the old-fashioned way. Mm-hmm. And if all you have to do is look at the Famous Brand share price over the last 5 years. It's really, I think, almost 400%. So not bad from a guy from East London.
Certainly has made shareholders very happy. I think it recently surpassed the 80 rand mark. I think it might have been, in fact, this week. But Thandi Sizwe, what do you think it is about the fact that he perhaps didn't have that academic background, the CA title attached to his name, that has helped him build this quite innovative brand?
Look, I think he was quite an open guy to learning about business. He did mention that when he went on to join Famous Brands in 1999-2000, one of the traits that he had were managing people, managing processes and systems, and that's what he brought to the business when he started at Famous Brands. And those were the three sort of secret ingredients that he brought to the company. And I think he's learned that throughout his experience, obviously at SAB and Distel. And I think he also went on to start his own pub also in East London, where he, after having been at SAB and working as a sales rep, he started his own pub in East London, his hometown, and he then went back to waitering. He was a waiter, he was serving drinks, he was scrubbing floors. So I think this is a man who truly understands what it takes to run a business and run it successfully. Mm-hmm.
I mean, just looking at what he talks about when it comes to the people side of the business, it seems like he really has not forgot that it's people who run a business and not computers. Very people-centric focus, and of course that perhaps a lesson to learn for other leaders or to take from this.
Absolutely, absolutely. A business is nothing more than a collection of assets, and assets don't run themselves. They need people to execute on the strategies. Because Famous Brands and its franchisees and the broader network it supports, which is not just Famous Brands, it's entirely people. It's people-facing business.
Mm-hmm. Let's bring Anthony into this conversation. Anthony, thanks for joining us, of course, from our Cape Town studios. Talk to us about your views on the leadership and the man behind Famous Brands. Of course, we're talking about Kevin Hedderwick.
Well, I think, in the last decade, he's done a fantastic job in building up a small business, basically from a couple of underlying brands into a multi-brand format, catering to a number of different marketplaces in this country and, of course, overseas. And I think his key determining factor is identifying what the next possible trend would be in consumer diets and consumer trends, looking for a brand that is perhaps slightly faded, where the machine of Famous Brands can be bought in to make it more efficient, and where the capital that the company has can be used to develop and exploit that brand. And if we look at what he's done, for example, at Mug and Bean recently, what he's now doing with Europa and Tasha's, it shows you that he sees a great format. It can be rolled out, and using the machine of Famous Brands and his leadership and his determination, roll out a very successful franchise.
Mm-hmm. This is a franchise model that really does work at an interesting time in South Africa where, for example, some companies, and I suppose that's in the retail space, but Woolies choosing to go the corporate model and buy back franchises. But Famous Brands has really got the whole franchising model so right. Why do you think that is?
Well, you've got to have top-tier brands, strong brands, or competitor-level brands. Then, on the second hand, something that we haven't really touched on is Famous Brands' almost secret weapon, and secret in inverted commas because it isn't so secret, is its backward integration. This is how you control the supply chain and you sell into the captive audience that is the franchisees. Well, because you control that supply chain, you're also controlling the quality. And at the pay point, really, a brand is nothing more than pricing, product, and positioning. And by controlling that quality, the brand, the franchisees, you control you control the whole network, and so it starts to get a momentum of its own, because that's essentially what you start to sell is an investment to a potential franchisee. And as they see them become more successful, they want to buy more. You want to bring in more franchisees, and they start phoning you. So I think it's a combination of all these success factors that all accumulate that arrives at a successful master franchise operation like Famous Brands.
I was actually speaking to Anthony about that when I wrote the story, and the best way to think of it is if you're someone sitting at home and you're wondering how this works is if they're selling a burger and it's worth 20 Rand, it's very difficult for them to up the price when they've got competitors probably priced at a very similar level. If they control the entire supply chain, they can really squeeze efficiencies out of that and lower their cost base, and that's a way of expanding.
Managing margins, expanding margins.
And expanding your margins. So Anthony, I'm sure you can hear me. I think he was saying if that's the beauty about buying Famous Brands. They might not have the growth of say a Spur or even a Taste in terms of potential, but what they can do is if they can just squeeze 0.5% out of all their margins, it's almost as powerful as them buying a reasonably sized acquisition.
Mm-hmm. So Anthony, let's get your views on that, and how much more is left to squeeze out of the cost side of the business?
Well, I think you've seen with the other fast food companies, Spur and of course Taste, they've actually followed the inspirational model that Kevin started with his central kitchen, manufacturing, and of course logistics operation. And simple things as manufacturing your own burgers, or your own soft drinks, or your own water, or your own ice cream can add a significant amount of margin to your bottom line. And I think the other companies are now following what Famous Brands started many years ago and are doing incredibly successfully. I think in their case, many of their internal products, apart from the underlying branded goods, are now sourced internally, and just by squeezing and tinkering with that chain and adding incremental new products on, you can actually add to the bottom line of the business. As I said to Garth in the article, it may not sound like a great deal, but just by tinkering with the margin, an extra 50 million Rand could easily flow through to the bottom line just by procuring better and manufacturing internally. So I think going forward, as the company starts to expand into other areas, and they are looking at areas that they haven't currently operated in, such as chicken or the lower LSM sit-down convenience market, there is certain synergies that they can actually pull into that model, and they've got the machine there to just keep on rolling out this cost benefit to whatever brand they add to their portfolio.
Mm-hmm. Tandisizwe, when you look at the company now with such kind of well-established brands catering to certain various LSM groups, you've got Tasha's, we've got Europa, you've got Debonair's Pizza, Fisherways. What's missing in their offering?
Look, I think it's pretty clear in their portfolio that one, the family sit-down convenience restaurant structure is also missing. Also, expanding their market to the previously disadvantaged or lower LSM areas, which I think they could also make some money out of it. Because I think one of the ingredients, again, that Kevin has successfully implemented in the business is that he understands it. When he sees the market, he studies it carefully and he understands it. He alluded to the fact that, you know, in South Africa, even though they offer the products across the board, especially more so in the high LSM or middle to high LSM, they recognize that in South Africa there are millions and millions of people who may have only a 20 rand on a day, but they need to eat lunch. As a result, they can go to a black steer, for example, and get a good burger and have good lunch. So I think if they extended that to that knowledge to other markets and to those previously, you know, under service markets, I think they can also get some growth out of it.
I think, in a word, what they're missing is chicken. Everyone talks about that. Problem is, it's a very difficult area to get into, because
I mean, KFC, Nando's, you know, they kind of cater to the market already quite well.
And they're big operators to go up against. And when I spoke to Kevin Hedderwick, he was very forthright about that and said, look, it's very, very hard to get into the fried chicken market. And if you don't get into fried chicken, well, then you're up against Nando's, which is more and more looking like what he described as, you know, probably going to be South Africa's first global fast food brand. I tried my best to get it out of him where they'd be looking. He didn't give too much away.
Did a twinkle come in his eye when you talked about anything in particular?
Absolutely no twinkle at all. Absolutely no. He didn't give anything away. I kind of, you know, had a look out there, and Chicken Licken is a very, very big South African, homegrown, you know, chicken franchise, and I did put it to him and I said to him, well, what about them? But it turns out that the owner of Chicken Licken, a guy by the name of George Sambonas, is highly unlikely to sell. Someone inside the business told me they'd be together till death they do part, and they meaning George Sambonas and Chicken Licken, so that sounds like it's not going to happen. And Kevin said to me himself, he said, well, look, they also operate in the fried chicken area, which is just quite a difficult segment. So it's anyone's guess where they'd go. I'm not sure what Keith and Anthony think.
What do you think is an acquisitive target right now for them? Do they need another acquisition to fuel their growth?
This is where I'm going to differ with the general market perception. Is I don't necessarily think they need a massive chicken operation. There it's a very competitive space. You're against two big, arguably three big players. Moving into it is going to be margin squeeze. You don't necessarily have the returns to scale overnight that these guys do. So your return on invested capital will not actually be that great for pushing what? Really, and fried chicken has been a growth portion of the market locally. But what's happening is that the LSMs are trading up, and they're trading up into pizza. Interesting enough, pizza is one of the faster growing ones. Like a good example is Kevin rolled out a concept drive-through Debonair's in Soweto, and it's doing very well. So these low LSMs are trading into pizza as an aspirational food. So I absolutely disagree. I think you can just add in chicken into the broader menus or across your entire network. You have the aspirational brands the guys will trade into, and as you roll into Africa, you can roll out the slightly lower LSM stores, the Black Steers and the like. Then there's the final thing is that what's being a very uncompetitive. What's the word I'm looking for? A very contested market where there is no dominant player is essentially the breakfast market. And it's simple enough to introduce breakfast to your existing network. Steers already introduced breakfast, Wimpy's got breakfast.
Tasha's also kind of at the side
absolutely,
of the market.
Breakfast at different LSM and different market spacings. Okay. But you're just leveraging the same network with not having to put one massive lump sum, do an acquisition or take a massive risk. You're just incrementally boosting volumes, by broadening your menu.
Let's talk about geographic expansion because we talked about, Anthony, I'd just like to get your views on this because basically Garth talked to Kevin about this and he said that it seems like emerging markets are the space that he's looking at right now. It's bigger than just Africa. They like the model of Nando's. They like the fact that Nando's is going to become a global brand. It seems that he almost has ambitions to emulate that. Do you think that that's on the cards for Famous Brands?
Well, there's not a great deal they can actually left to buy in this country. And if they were to expand into Africa, we've seen what Spur, for example, has done. It takes a great deal of time to actually find a location and to move into a country and successfully develop and market that franchise in a new African country. It does take a great deal of time. Wimpy is well known in the UK. Debonair's Pizza can easily be transferred into other markets. He talked in the Finweek article regarding India. So I think moving into emerging markets for him would be a nice move. Traditionally, South African companies have gone to English-speaking markets, the UK, Australia, New Zealand. So perhaps moving into a more dynamic markets, for example, India, or even some of the other Southeast Asian countries might be a choice for him. But that doesn't come with an easy risk because the supply chain dynamics in that country and consumer tastes, need to be taken into account.
How costly do you get a sense it will be? I mean, can they just take the model here and transport it and put it down in India per se?
Well, Kevin said to me openly, he said, look, if we take if you take Debonair's in its current format and try and roll it out in India, it's not going to work. Obviously, there's cultural differences. An obvious one is people in India generally don't eat beef. And they will have to look at re-engineering it for that market. He was quite open about that. In terms of cost, I honestly have no idea, what the expense would be to roll out something across India. He struck me as someone who's quite cautious. I can't imagine him, rolling out Debonair's across the subcontinent. He'd probably test out one or two and see how it goes and then build from there. And I'm guessing, that's probably going to be a strategy that'll be a wise one long term.
But almost 90% of their profit is coming still from South Africa, so still very much South Africa focused.
Very much so.
Yeah, we're going to have to leave it at that. Of course, there we go. If you'd like to find out more about the man behind Famous Brands, you can do that in this week's Finweek. And of course, thank you so much to Keith McLaughlin, a small caps analyst from Tebe Securities, stockbrokers rather, and Anthony Clark, also a small caps analyst at Venani Securities, joining us from Cape Town. It's time now to take a quick look at the Finweek trade of the week. Well, the trade of the week this week is Sibanye Gold, and it's of course the flavor talking point of the week because it listed on Monday and it's shown a 30% return so far. Why is it the trade today?
Well, look, here's a company that was obviously hived off from Goldfields, the fourth largest gold miner in the world. They listed at about 13.20 on Monday. And it was at the bottom of analyst expectations, which was between 8 Rand and 50 Rand. And interestingly, more than 33,000 shares on the first day were traded. And it's had a pretty decent run. It's up at 16 Rand 30 as of yesterday, and
17 Rand over 17 Rand as of today. So it keeps rising.
Absolutely. But I think the interesting thing is what is in it for investors in the long term. If you look at the uncertainty in the mining sector, I think at the moment it's not the flavor of the month. As we saw what happened last year with the Maricanas of this world, and how it's continuing the uncertainty. Just the weekend before Sibanye Gold listed on the Monday, on the weekend, NUM members had actually staged a protest against the listing of Sibanye Gold and against the unbundling of those assets from Goldfields.
Yeah.
So I think that's also a sign that more sort of labor uncertainty will face the CEO and the company.
Well, we'll leave it at that. Thank you so much for that. Of course, if you are interested and prepared to take the risk, there's Sibanye Gold. It's shown a 30% return. So if you bought it on Monday, you're still smiling today. It's time now to pay the bills. We'll be right back after this short break. Well, Welcome back to Finweek Money Matters. As calls for financial planning intensifies, the innovators have come up with tools to help consumers achieve this now, but there's been mixed reaction to this, not necessarily to the efficacy of these, but the risks this may pose. Some banks, including the Ombudsman for Banking Services, have said that submitting sensitive personal details to a third party posed a fundamental risk to consumers' security. Well, we'll find out about all of this with our panel, Jessica Hubbard from Finweek, Stephen Cohen, MD of Sage Pastel, Justin Bradshaw, Head of Nedbank Personal Finance Management, and of course Garth Tennyson is still with me at the desk. Jessica, thanks so much for joining us, and of course Stephen and Justin, thanks so much for your time. Jessica, give us a background to all of this and the innovations we've seen in personal financial management.
The PFM, personal financial management scene, kind of got kicked off, I'd say last year, April, when 227 technology startup headed by Christo Darvel, one of our more well-known entrepreneurs in the tech space. He launched 227 to basically aggregate consumers' personal financial data, and their whole intent was to lay it out in a very attractive graphical way, so that people could see exactly where their money is going. Do they spend too much on entertainment a month? Are their bank charges too high? And in that way, help them to budget more effectively. Mm-hmm. It was a controversial launch.
Graphically, charged website, so it helps you understand.
It's all about the graphics.
Yeah.
So you see it in pie graphs and bar charts and all of that. And banks didn't react well to it because Christo Darvel didn't coordinate with them, so to speak. Mm-hmm. And the banks came out and said there's a huge security issue. You can't give out your online banking details to a third-party provider without our permission. And all of the banks, excepting for FNB, didn't allow or didn't give their customers permission, so to speak, to use the service. And they said if something does happen, if there's fraud, we will not be responsible for it. You are liable. In the interim, the banks started working on their own personal financial management tools. And we've seen Nedbank come out with one, Pastel's come out with one. So it's an interesting space, and not everybody is charging for it. 227 does charge 70 Rand a month.
Yeah, you've got a 1 month free trial there. Nedbank is free, of course. You have to be a Nedbank customer. But
no, you don't.
No, you don't.
You can be any South African person. You can register for My Financial Life, and it's free.
So basically, this is obviously an innovative tool to be able to see where all your money is going and how much money you have, how much money you need to save to reach certain goals. But talk to us about the security issues. Did Nedbank have a problem when 227 came out with their product?
Well, basically our response to 227 is simply that clients must make their own choices. And if they're going to give their credentials to a third party, they must make sure it's a trustworthy third party. If they want to find out from the bank what their opinion is, they must come and speak to us and find out the risks of giving their credentials to that third party. And basically, if their credentials are compromised to a third party and losses do occur, then yes, that is at their own risk.
But have there been security issues post the launch of 227?
There haven't been any security issues, and if you look at Yodlee, who is 227's aggregator, so to speak, they gather the information for 227. They're a US-based company. They haven't had any security breaches, and most of the big banks in America, Bank of America, Citibank, they make use of Yodlee, so they do have an impeccable track record. So the argument that your financial details aren't safe, it doesn't really hold water. Not that I can gather.
Well, your thoughts on that, Justin? You've developed your own models.
My name's Stephen. Sorry.
Stephen.
What nobody's discussed here is that FNB have provided you with a secondary logon, and it's read-only. So even if that information is compromised, that particular user can only read information. So they can't pull money out of your account. And FNB were the only bank at the time that was prepared to do that. And I'll be a bit controversial. I think that you guys and ABSA didn't want to go for this because you guys were developing your own software. And I think that that's why you guys gave 227 a hard time. You could have done what FNB did and just give a secondary logon with the credentials. What Pastel have done is we completely agnostic, and I must say I wasn't aware that you guys were agnostic as well, that you could allow people to use other banks.
Sure.
So hats off to you for that. But we're a software company. We've been around for 20 years. We have hundreds of thousands of users, and all we're trying to achieve is that if people are comfortable with doing their financial stuff personally, then that'd be quite cool to go and use it for their business as well. And we didn't create this market. Intuit in America had a product called Quicken in probably 1990, and they had 10 million users. They created the market. But what's interesting for me is that the web now has really allowed all of us to play in this online space, which makes a hell of a lot more sense. So you can tie it up to internet banking and all that stuff. And I think that's why you're seeing so many products come out now, because the web is the perfect platform. But the security thing, I mean, we all got 128 levels of security and all that kind of stuff. I'm sure there's some Russian hacker that if he really wanted to...
Is it water under the bridge yet?
Well, I mean, the way Nedbank's approached it is when you log on to internet banking, you use a profile, a PIN code, and a password. So when you're linking an account using Yodlee, because we also use Yodlee, you only use the PIN code. So it's not a